Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles. And joining me today in spirit is Michael Becker, but not in spirit is James Eng. James, how are you?
Great, Paul. Thanks for having me.
So today we're going to have an interview with some guys that acquire and hold Class A multifamily properties in the Dallas-Fort Worth area. We're joined today with a group called CAF Companies, And CAF is for Chris Faulkner. Chris Faulkner?
That is right.
Chris, how are you today?
I'm doing very well.
And also joining Chris is Trent Wood. Trent is with also CAF Capital, and he's the president. Trent, thanks for joining us.
Thank you for having me.
So we're going to talk a little bit today about Class A properties. A lot of people that listen to this podcast actually listen to it is wanting to get into Class A at some period of time. Chris has broken through to the Class A multifamily, and today we're going to talk a little bit about what Class A is all about. You know, why does he like it? Why does the institutional people like it? Why do we want to get into it? If it's something good to get into, I'm going to throw it over to James a little bit. James, let's start our conversation with Chris.
Great. Thanks a lot, Chris. So Chris and I both grew up at GE Capital to some extent. And Chris, maybe fill in the gaps and tell us sort of how you got into Class A multifamily.
Well, so yeah, as James mentioned, he and I were both at GE Real Estate I was there for 15 years. How long were you there?
10 years.
10
yeah.
years, right. That's a good tenure. So, GE in itself is an institution. So what we acquired and what we worked with primarily was institutional quality real estate, anywhere from retail, industrial, office to multifamily. I started off not even knowing what net operating income was to securitizing deals on Wall Street. So, it's quite an education at GE. And the longer I was there, the more I realized, I think I can do this. I always wanted to be on my own, and it was always a dream of mine. And then in 2008...
we all know what happened in 2008.
The music stopped, right? GE basically, bought every property they could, and they maxed out their credit card, basically. That's hard to believe, but that's really what happened. And so at that time, I was providing joint venture equity to people like CAF Capital Partners. And so I had a very good seat at the table to see how operators worked, what they did well, and quite frankly, what we don't ever want to repeat. So it was a great seat at the table to see all of these situations. And then in 2008, we basically stopped the JV program. We just completely stopped providing joint ventures, stopped acquisitions altogether. All of us acquisition types were moved to asset managers. And so it was really a great opportunity for me to learn, there is justice. When you buy these deals, then you got to go manage them. So that's kind of what happened to me. So we started to manage all the deals we acquired and got a really good feel for what it takes to operate a property, specifically multifamily. So I spent the last 3 years of my career at GE being a multifamily asset manager. During the 2008 timeframe, however, a good friend of mine from my church, who is about 20 years my senior, he and I just clicked. He's a very, very deep-pocket individual. And it was a relationship that we just cultivated. And one day he asked me, let's go buy some deals. And I was not ready. And I told him that. And he said, how much money do you need? And I said, probably $15 million. And he goes, that's it? And I said, yeah, $50 million. What do you think I said? So
that's a good guy to know.
Yeah. So, the reality was he was more liquid back then. Everybody's life changed in 2008 and 2009. Okay. So fast forward to 2010, we've been meeting quarterly. And the reason why I'm spending some time on this for those of you who are listening is it's one thing you cannot ever underestimate is who you will meet and how it may or may not change everything. So don't ever discount relationships because you don't know what kind of fruit they're going to bring. So with that in mind, we met quarterly. I'd always buy him coffee. I treated him as the godfather, which we refer to him today. And he was so important to me, and I did everything I could to make sure he knew that the fabric of my content, my character, and that he could trust me, because clearly that's all that matters when you're talking about money for the most part. So we met quarterly. I told him what I thought we could do. In 2010, we decided to go ahead and move forward. We got our first deal. This is a transaction that, quite frankly, fell out of contract twice. So here I am bringing this dead cat into my partner saying, hey, what do you think about this deal? And reality, my experience at GE, I knew it was a great deal, but it was 2010 and nobody was buying and nobody knew what a great deal was because, quite frankly, nobody knew where the bottom was. Were we there yet? So what we decided to do was we decided to focus on the fundamentals of the asset, the transaction, which are the cap rates and the rents. And we teamed up with a third-party company, Westwood Management, which they're amazing. They were highly recommended. They were referred to me by CBRE, which is an institution here in Dallas, globally actually. And that's a whole other story. They thought I was bringing them GE business, so they booked the meeting, and only to learn, how many properties are we talking about? And I said, well, including this one. So but we got along, and they ended up, I think they kind of saw that there was some potential. So we acquired our first deal, and thankfully, and look, I realize this is an atypical situation, but I go back to my statement: you never know who you're going to meet that may change everything. So when we brought our first deal, I told my partner Doug, I said, "There's only one way we're going to get this deal, because it's already fallen out of contract twice. The only way we're going to get this deal is if we show them that we have the equity to close, and that's it. I have the resume, Westwood has the management, you have the balance sheet. We have everything we need." And he said, "Well, how much equity are we talking?" And I said, "It's about $7.3 million. And my partner said, and rightfully so, "That's too much money for one investment." I said, "Don't worry, we're going to syndicate it during the assumption process." We didn't do that. So I think we syndicated $1 million. It's tough when you're starting because people don't know who you are. I was at GE, I kind of hid behind that logo for a while. But when that logo comes off, you're just the same as everybody else in their eyes anyway. So a little bit of pride, I had to swallow hard. And so that's how we started our first deal. And from there, they always say the first deal is the hardest one to do. Amen to that. It was tough. It was a lengthy assumption process. Through that process, Trent and I began to work closely together. And Trent's our president of CAF. He's the heir apparent to the company, actually. So he's not seen as equal in terms of a business acumen. His mind is incredible. So we have all the great players, thankfully. It took us a while. But after we got our first deal done, Trent and I started talking about things to come. And so I'll turn it over to you. I know that was a bit of a monologue.
That was great. I mean, just to give us the background and history of sort of where you've come, and just maybe tell everyone sort of where your portfolio is at now. So that was the first deal in 2010.
Right,
and
right.
So now
right.
Where you're sitting, how many transactions have you done, and sort of where the portfolio is today?
Well, the good news is we've done all the transactions, and that's a little tongue-in-cheek, but there's a lot of deals that come in and they fall out. And I can't stress to you enough that it's worth the work to do it right the first time, because if you do blink, your trust factor will be diminished in the market quickly. So I'll answer the question quickly in that where we are today is we currently own and operate 12 properties, but we're about to bring another one on third-party management that we will ultimately own. And we have another 3 under contract. So we're talking at 53, almost 5,400 units that we have, and they're all Class A, which is unusual because, quite frankly, some of the people that we used to give money to had portfolios and companies the size of the one we have now. And we still feel like we're at Starbucks talking about how we're going to get this done. So that's a quick answer to your question. The way we went about doing it was look, first and foremost, I'm a church-believing Bible guy, so a lot of prayer, tons of prayer, a lot of crying, but that's the backbone of the company. And so we took that level of faith and then did what we could do, and that is, if you look at our dead deal file, you would laugh. It looks like a dictionary. It's just every deal, and every one of them were modeled. Every one of them were underwritten. Every one of them were either windshield toured or toured. So there's no lack of effort of work. We probably put, I don't know how many miles on our car in the first couple of years looking at deals, and that was just Dallas. Now we've been to Houston. We own in Houston. We're about to own in San Antonio and Austin. So we're covering the state, and I just prefer car time. I think it's important you can get more work done. So we built the company by this one phrase: do the right thing, risk the consequences. That's what we do. So when it comes to our investors, they're our number one customer. The truth is, everybody is your customer. But there's some apparent customers in this business, and number one, our equity. We treat them like they should be treated, and that is they're taking a risk on us by endorsing, either we're smooth talkers or we are deliverers of reality. One of those two are going to transpire through the relationship. So we do our best to make sure we always do the right thing. And if it means sacrificing some things that come out of our pocket, we will do it. Why? Because we don't live for today. We live for tomorrow. And we think that if you invest in people like they're investing in you, then you'll see more of them. And we all know what that means. So just a little bit of a thread of the culture of the company.
So when you're going through, that dictionary, dead deals, how are you guys, when you underwrite a deal, choosing which ones to go under contract? Because obviously it goes through a lot of scrutiny, but maybe one or two things that are on top of your mind right now when you're getting deals under contract.
Great question. So I think you have to have, every successful company has what they call a secret recipe. We're all probably thinking about Kentucky Fried Chicken or McDonald's. They always say they have the secret sauce. I'm not saying we have a secret sauce. I just know we have a system that we don't deviate from, and that has proven to work very well. And I'm not proud. I'll be happy to share it because I think it's important. There's plenty of deals out there, so I'm not worried about someone picking up our plan. But what we do is first, when we approach an acquisition, the first thing we look for, there's 3 tenants. It has to be on or near a major freeway system. It needs to be within at least a mile of a grocer or a major retail node. And then finally, it has to have some sort of a differentiator. What is that differentiator? It can be next door to a dog park, like a city dog park or an amphitheater. It can be on a golf course. It can have an on-site pond that's spring-fed, something that differentiates it so that if we do need to sell and we're amongst other properties for sale, well, there's something different about us that would attract us, and it makes it more liquid, and that's proven us well. So we have a lot of properties that are on golf courses. Every property has some sort of a differentiator. The other thing is, as we acquire and what makes it a dead deal, we can look at a deal now and know with those tenants in place who our equity is going to be. Now, it doesn't mean they're going to say yes, but we can look at this and say, oh, this is a so-and-so equity deal. This is a so-and-so equity deal. Because quite frankly, if you want to get very, very down to the basics, what I do for a living is I handle money, but I use real estate as my vehicle to do that. So we're in the business of making people money and through real estate investments. So when we look at a deal, we know, oh goodness, this type of a deal is an opportunistic buy, which really is what attracts this particular equity. And then this one's a really meaty value add, which is this kind of an equity. So again, that comes with rhythm. If you want to take a look at the rhythm of how we grew, we bought one deal in 2011, one deal in 2012, one deal in 2013, and then the rest came in 14 and 15.
It's a little bit of a hockey stick.
Yeah.
So my question is why Class A instead of B and C? Why did you jump into Class A instead of more value-added or even stabilized B and C properties in the Dallas-Fort Worth area? What were you drawn to on the Class A stuff besides being newer? Yeah,
right. Well, so it's simple, and everybody listening, it doesn't matter what asset class you go after, by the way. It's just go with what you know. I understood Class A, and that's all I knew at GE. So why would I try something different? So I knew how to do it. I knew how to manage it. It made sense to me. I didn't have to think about it. I just had to implement and find the equity, all that other ancillary stuff. But I knew people could trust what I was saying because I'd been there, done it. If I were introducing a new concept, I don't know that would have been the same. So Class A, outside of that particular reason, look, it's a very granular asset class. First of all, multifamily. Secondly, Class A is usually institutionally owned and operated, so you can trust the product. Mm-hmm. You don't come on there and find a whole lot of issues. And when you do, during the due diligence process, usually you have some level-headed business owners that know how to solve problems, and so no one's pointing the finger or trying to get away with anything. So when issues do arise, then everyone plays well. Yeah, you're buying from institutionals instead of the mom and pops in perhaps the B and C marketplaces where you really can't determine whether the financials are accurate or not. Not to say that institutionals don't go off reservations sometimes too, but there's a higher trust factor in the quality of the asset itself. If, being that it's probably 10, 15, 20 years old, in better condition, made with better materials than if it was built in 1968 or 1975 or so. But talk a little bit about, if you can, we're in the epicenter
of multifamily in the United States, really Frisco, Texas, and your offices are in Frisco, Texas, overlooking Jerry Jones's Cowboys Stadium wannabe, which is the practice center, which is absolutely unbelievable. And your office is centered in the $5 billion mile. And we have thousands of jobs coming, hundreds of jobs coming, thousands of jobs coming to the Dallas metropolitan area. And with that comes people that are building brand new Class A properties. And I would think that would be some form of competition. Where do you find right now in the Dallas-Fort Worth area the level of new construction going on, and how much does that compete with what you guys do?
Well, it does compete, to be honest, because we have anywhere from brand new product to 1994 product. So we do see it, but we also realize that if you're in the right spot, it's always just a waiting game.
Location.
It's so, I'll give you a good example. We bought a property. I mean, most of what if you guys go to our website, CAF Capital Partners or CAF Management, you will see what we buy. And it's we always put the best picture we can find on the splash page, right? So it's very, very nice, attractive stuff. But most of what you'll notice is it's A- quality stuff, 98 construction, usually on average, 2098 construction. However, we have recently acquired opportunistically some 2014 to 2015 construction. In fact, we have 3 properties under contract right now that are all 2015. And the reason we're buying it is because it's an opportunistic purchase. It's not so we have different equity requirements. So we bought a property back in 2014. It's not too far from here. It's Platinum Castle Hills. You can see it on the website. Beautiful asset. Well, when we bought it, it had fallen out of contract. And by the way, every property we've ever acquired, with one exception, has been off market. And it's not from a lack of effort, I assure you that. It's just when you're starting off, it's tough to win the bids against the big giant Class A stuff. Okay, but what we became accustomed to doing is picking up properties that people would recklessly tie up and then only not perform. So we gained the reputation of performing. All right, that's critical. But that led us to this property. It was the end of the year. All the banks had their money in their pocket. They'd already met their bogey for the year. And we saw an opportunity. So we were approached by a broker and said, hey, could you get this deal to work? And we said, we will not only get it to work, we will close. And we'll close at this number, and we won't Mickey Mouse. The number wasn't what they wanted, but it was just kind of a confluence of events. The equity on the other side of the table needed to get out of the deal. They saw an opportunity, and they let us do it. So we bought this Class A brand new deal for a really cheap price. I'm not going to disclose that because any taxing authorities out there. But we bought this for a really cheap price, and we just figured, hey, this might be a good deal. Well, right when we put that thing under contract, 2 days later, Toyota announced their headquarters were coming here.
About 5 minutes down the road.
If that. I mean,
yeah.
John Daly could hit a driver there, right? So then the Nebraska Furniture Mart was already under construction. Right. The place looks 100% different today than it did when we went under LOI. Now, let's be honest, a lot of that's luck.
Yes.
Right? But the only way you get, people say, I'd rather be lucky than good any day. That was very lucky, very fortunate, but we were in the game. And when you're in the game, that's the only way you can get lucky. And so we never stop looking for opportunities. And I know everybody out there listening doesn't stop either. My point is, you just never know what tomorrow is going to bring. And so that's why you just stay vigilant.
Well, how important is it to close on time and to do what you say you're going to do?
It's everything. In fact, we had a situation once. It's everything, Paul. I mean, the reality is if you're selling your own personal residence and you have 3 offers on the table, you know which one you're going to take, the one that you feel the best about. And that's a lot of things that affect that decision. Earnest money, ability to close, how much money this individual makes, can they afford your home? It's no different, as we all know, on this side of the table. So what we do is we never make an offer on a property unless we have the equity tied up and we have our loan terms understood. Now, we've since hired, some people. We have a CIO now that is in an acquisition, so we do now make offers on properties that we don't have the equity tied up, but we kind of earned that right.
That's where my point is going, is that to get a chip on the table, you have to perform. And
it's everything.
It means everything. These sellers have relationships with the brokers out there. They have relationships with the debt. They have relationships. But if you don't perform, you're never going to have a chance to look at another deal that they're going to bring out.
And another thing is the brokerage community. I hope everybody can embrace the brokerage community because it is what makes real estate tick. I know a lot of people want to do principal to principal exchanges to save a couple of $100,000 or whatever. You actually are hurting yourself more because the brokers find out that you circumvented them and they're less likely to bring you deals. So I'm not saying it's kind of a cost of doing business if you think about it. So that's a side note. But the reality is we had one situation once where we were in jeopardy of not performing, and we figured it out. But let me just say one last thing about the brokerage community. They talk. In other words, I was playing golf with a broker last week, and I was telling him about a deal we had that we're currently selling. And I said, we're selling this deal, and I think I'm about to get retraded. And he goes, who's your buyer? And I told him, he goes, they will retrade you. And the other guy that we were playing golf with goes, well, I'm selling to this guy. He goes, no, they won't retrade you, but this guy will. So you will get a reputation in the market. Very important.
Great. Let's jump over to Trent for a little bit and talk about, originally you guys used third-party property managers and now you're self-managing deals. Talk about that decision and then sort of what you've learned since doing that.
Okay. Happy to. Well, originally when Chris and I got a chance to know each other also through church, and we got to know each other's character and personalities first before necessarily doing business together, that was actually a part of Chris's master plan, so to speak. And so when he laid out, I was in a different industry and in a different time, quite a few years ago, but he laid out his vision, which was first deal is going to be the toughest. Basically everything he just explained to you, he laid out before it happened. And I bought into that. I said, and we talked about doing business together. And so part of that master plan was to be able to be integrated with the operational side of it so we can manage and control costs and deliver better distributions and returns to the investors. So essentially, when you do your first deal, like Chris said, it's a monumental effort. And then you do your second one, and it's maybe 1% less painful, but still another monumental effort and so forth. And it was important for us to partner up with a highly reputable property management company, to which Chris did, with Westwood Residential. And they did a great job. But the plan was eventually to be integrated. So like I said, we can control the costs and we can deliver greater returns to the investors. So about the end of, I would say, middle of 2014, we're starting to get critical mass, 6 properties under ownership being managed by Westwood. We also had one property managed by Tipton. And they were doing well. And we talked and we said it's time for us to go ahead and prepare for the launch of CAF management. So over the course of about 6 months, we did a lot of business planning and performas, put the plan together. We knew, obviously, the plan was good, but it was only going to be as good as really the leader that we brought on the team, that true property management expert. So we had long discussions, but actually it was a short discussion. And we said there's only one person we can think of, and that's Brooke Hendry. And Brooke actually worked for Westwood Residential, and she actually was a regional manager for some of our properties. And she was so good and was so outstanding, we asked for her to manage some of the other properties and manage the entire Dallas-Fort Worth portfolio for us. So we had working knowledge. So we were blessed in the fact that we got to see the fruits of the labor and got to know the person, the character, the work ethic, and most importantly, the results. So we knew what we were getting, which was a superstar. And so that was the critical aspect, quite frankly. We had a great plan, but the plan's only going to be as good as the people that you bring on the team. So the pitch was made, and we outlined, here's what CAF, what our plans are, and this is how we want to grow, and this is what we want, the next step we want to take in the evolution of CAF. And we were thankful that she saw the same vision that we did, and she was excited about joining the team and helping us launch CAF management. So we transitioned January 2015 to start our management company with Brooke Hendry as our vice president of operations. She essentially, all the property operations report up through her, and we were able to make that leap. As you can imagine, the operational details that take place are quite large when you're making a transition of that nature. Luckily, in my experience, business experience, I've kind of gone through a similar transition before in a previous industry. So again, we had a good plan, but I think the plan's only going to be as good as the people that you bring on the team. So really, once Brooke was on the team, it was highly critical that we brought on the property level people that we needed, the leaders, meaning property managers and maintenance leads. And so we put together a plan to really outline our vision and spend a lot of time with each individual employee of those respective third-party management companies, employees, and say, you already work at the property. Here's our vision for the company. We would love for you to stay here and continue to work for CAF and help us start this company and grow this company.
I'm going to jump in. Keep in mind, most of these employees had been with their previous employer for quite some time. So this was no small undertaking, and it's no disrespect to the previous management company. It was just Brooke and Trent went in there with a with an incredible game plan and executed flawlessly, and we retained 100% of the people.
Wow.
So that was really critical to our success, is being able to retain those great employees at the property level, have them join the CAF team. And then, so here we are about a year and a half later. The first year, we learned a lot along the way, but we had the right people in place that had the expertise. And now it was about meshing, so to speak, CAF capital partners and our culture with this new management company we created and helping people understand. And it's really been tremendous to see. We had a great first year of success. We actually delivered 20% greater investor distributions from that first year. So I'm looking forward to seeing what year two brings. So we accomplished the mission, quite frankly, which was, quite frankly, every decision we make in CAF companies, because Chris and I get to oversee both sides of the house, so to speak, is number one, is this good for the investors? Number two, is this good for the property/residents? And number three, is this good for our employees? Doesn't necessarily mean we can answer all three in a yes, but if we don't, we always remember the investors come first, the residents come second, and the employees not necessarily come last, but they're the third component or third leg of the stool, so to speak. So that served us well. We'll continue to do that in the future. So with the investors in mind first, I think we were able to accomplish the mission, which was deliver greater returns to them. And so that'll continue to be our focus.
Looking back, if you could talk to yourself in January 2015, what would you tell yourself that you know now?
Great question. Let me think about that. I think what I would do maybe differently or maybe improve would be probably think a little bit more about the organizational structure to manage the growth.
Okay. Yep.
That's always, I think, for every person I'm probably listening to this, is have smaller, maybe medium-sized organizations, managing your growth and being able to bring the right people on at the right timing. Probably building out that org chart, so to speak, hypothetical org chart, prior to actually being in the weeds of it and saying, okay, now I need to do it. I would say probably would be one thing.
Yeah, and on that note, our goal for, as James mentioned, January 2015 is really when we started. Our goal for the year was to double, and we did, and thankfully, but we didn't necessarily consider how to staff up accordingly. So this year, it was Trent brought up, right at the beginning of the year, a hypothetical org chart. He went ahead and did it for 2016. Right. That's probably why it came so easy for him to answer the question that way, is because it was difficult. I mean, people matter most, and if you have the right people, then you'll achieve what you want. So I think he's got this great org chart that I cannot afford right now, but it's there. So,
and with that is we know we can't fill it out overnight, but as we grow, it makes it easier to visualize and prepare, and me to prepare Chris to swallow the new personnel and saying, okay, this one's the next one. So that's, looking back, I think I would have done that sooner. But, the way that we were able to get the people on board, I'm really proud of. And that's a testament to also Brooke's credibility with the team. We had a good plan, but quite frankly, she had built a tremendous relationship with them. So when we cast the vision of this is what we're doing and this is where we're going and this is how you can be a part of the team, it's one thing for me to say it. It's another for her to be saying it alongside with me, because quite frankly, they had a longer history with her.
Yeah, I mean, it's amazing. I mean, you guys have laid out the plan, sort of executed the plan in the last 5-6 years. So what's the next 5 years look like for you guys?
Well, I'll let Chris answer that.
We all know that, you've heard it said, without vision, man perishes, right? So everyone always asks me, what do you want to do? And I got to be honest, I want to create an empire. It's always been inside me. So I just go with what I want to do, and I work accordingly. So the next 5 to 6 years, we want to have 50 properties within the next 3 years, really. But we want to be a major region. When we wooed Brooke to the company, I told her, I said, I think we're the next generation of real estate moguls. So we think accordingly. We always think bigger than we can ever imagine, and I think that's important.
On that note, I think, what we've been blessed with is Chris is a true visionary. And obviously, I've had a lot of big business experience just like him, but when he casts a vision, you kind of catch a hold of it and it captivates you. Where I think our partnership works really well is I like to take things that are already existing and try to make them better. Sure. And so while he's casting vision to continue to acquire, to become the next real estate mogul, and do it in a way that we're proud of. I think Brooke and I and the team really try to focus on what he's blessed us with and be good stewards of that. So he acquires a new property, we look at it and we see the underwriting, we see the strategy, we see the plan for the renovation if that's applicable, and we say, how do we make sure not only do we hit this, but we exceed it? And I think that synergy for those that might be listening and they may have either a partner or somebody that works for them or maybe a team of people is being able to make sure that you've got, Chris is truly the visionary, and then we try to maximize the opportunity in our hands.
Talk to me a little bit about some of the challenges today. I know you guys want to get to the 50 property portfolio, but what are some of the right in front of you challenges today? Is it trying to acquire the property? Is it capital? Is it underwriting these deals to be more conservative going in the future? Tell me give me an idea on the Class A stuff of what you're seeing that you have to keep an eye out before the road turns.
The road is not straight for sure. This cycle has been a little longer. It kind of reminds me of the late 90s cycle, just by virtue of everything was pretty stable for quite some time, up until about 2003, and then it got real frothy. But when you say what are we worried about, what obstacles are we facing, we don't, this sounds silly, we don't think that way. We're mindful of the market fundamentals, and we try to stay ahead of that. But the equity is always going to be a relationship thing. So to the extent you don't like, relationships, that's always going to be an obstacle for you. That's my favorite part of what we do, because you get to a point where you can look at a deal and decide relatively quickly if it's going to be a good deal or not on its face. And then you have to understand the deal, and that's where you're inspiring the equity to come alongside. And so that's if you want to consider that an obstacle. But I think really what we have here in Dallas, and I can't speak to the other cities because they're just not built the same, is we do have a long runway still. And in light of what you're seeing, I mean, when I was growing up, my dad was in construction, and he told me that all these cranes, he goes, yeah, that's the state bird of Texas, son. So, here we are again, cranes everywhere. And it makes you wonder, are we getting out over our skis? And then you realize that when all these companies announce that they're coming to the Metroplex, there's this shockwave of emotion and excitement. But the warm bodies haven't even hit yet. And I tell you, I live in Frisco, and this 5 billion mile, the traffic is getting thicker and thicker every single day. Housing prices, everybody wants a house. And people have decided that they want to rent. So we do have the right fundamentals here, so we don't have any, the obstacles really are just making sure that our next hire is going to be the right person. Because he knows better than anybody, he being Trent, that if you bring a bad egg into the office, it can affect everybody. So really, what keeps me up at night is making sure that the culture we have remains healthy like it is now.
Without giving away the secret sauce, but are your equity investors typically like family offices, individuals, institutions? Give me kind of an idea.
Yes, it's all of that. In fact, it's just transformed. Obviously Doug was my first equity source. He's a partner in the company. But beyond that, it went from family offices to broker-dealers to institutions. And then currently we have a pretty strong Asian investor that goodness, how much have we done with those guys? We've done a lot of equity with those guys, over $200 million of properties. So it's interesting. These are bigger deals, right? Class A's are bigger deals. I mean, we will be managing over $500 million in real estate.
What's your typical sales price of your properties?
Anywhere from 35 to 50 million per asset.
Okay. I mean, this has been great. I thank you guys for really sort of sharing the vision for the company and sort of sharing your knowledge. I mean, a lot of people don't get to sit down with someone who owns, manages, runs 5,000 units typically. So I think sharing your knowledge has been great. Any sort of parting words in terms of, for those guys who were 5-6 years ago, any parting words for those investors out there looking to get started in today's market?
The only thing I would say is, I'm not going to get all inspirational speech on you, but you're better than you think you are. And if you start to think that way, and just don't ever underestimate what you can do. And surround yourself with people that can help you believe that. And that's not, hope that doesn't come across narcissistic. It's more of an internal battle that we all face, let's be honest. So the way you think is really where you're going to end up. And that's really what I would pass along to anybody who's doubting whether they can do something or not.
I would say, and this really just goes back to Chris's point, credibility. Focus on credibility. Focus on figure out what your plan is. Chris knew what his plan was, which was Class A. That's what he knew. That's what he was an expert in. Why deviate? Built credibility in the market. I've had a front row seat to watch it. And then number 3, and I get a chance to do this now and continuing in the future, Chris and I have talked about this, is as you grow your business, don't forget where you started and don't forget how it came to be. So Chris is out growing our business. I call it inorganically, finding new opportunities. And I'm trying to steer at the home office and grow it organically. But as he goes out and meets with equity, I always get the opportunity to remind our employees that, sometimes they just look at the current picture and think, we snapped some fingers and it occurred. And I got a chance to see, Chris and I sitting on my patio and him and us discussing, how are you going to get this done? And him being real and saying, I'm not quite sure, but we'll figure it out. And seeing some tougher moments. So I guess my point to everyone would be, put together a plan, make sure you stay true to that plan and you're credible and you follow through with your word. And you're going to have some dark moments and you can get through it. Like Chris said, you can get through those dark moments. And it took Chris how long to get here? From 2008 to now we're in 2016. And it took a lot of blood, sweat, and tears to get here, so to speak. And it doesn't happen overnight. But it's been a pleasure to watch, that's for sure.
No, it's great. If people want to reach out to you, whether if they have a deal or want to invest in a deal or anything along those lines, what's a good way to reach out to you guys, whether an email or phone number?
Yeah, before they invest, they got to get to know you a little bit per SEC. So what's the best way to get in contact with you guys?
The best is, I'll just give my email address. I don't mind. It's Trent@cafcapital.com or Trent@cafmanagement.com. Or if anybody goes on the website and forget that, there's a contact us click, which is an info@cafcapital or cafmanagement.com, and I get all those too. So I'm happy to be the first point of contact for anyone, and then we can see where we can connect people from there.
That's great. And Chris, Trent, and James, thanks for getting together with us in the podcast. We appreciate it. Some great information on Class A properties. And if you want to get a hold of Trent or Chris, follow those instructions to go to their website. Again, thanks for joining us today, guys.
Thank you.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview. Thank you for listening to the Old Capital